What is up, everyone? It is your boy Emser, AG, the Asian guy, and today I'm going to do something that might surprise you. I'm going to tell you that something you probably believe about the silver market is wrong. I'm going to show you data that contradicts one of the most popular narratives driving prices right now. And then I'm going to explain why, even though the narrative is wrong, the conclusion might still be right. This is going to be one of the most important videos I have ever made, because it is about something that affects every single person holding silver or thinking about buying it. For months now, the silver community has been buzzing with talk about China restricting silver exports. You have seen the posts on social media, you have read the articles, you have watched the videos from other channels talking about how China is locking down their silver, how they are preparing to cut off the West, how this export restriction is going to create a global shortage that sends prices to the moon. I believed it too. A lot of smart people believed it. But here's the thing about being a serious analyst. When new data comes in that contradicts your thesis, you do not ignore it. You do not pretend it does not exist. You examine it. You understand it. And then you update your view based on reality, not wishful thinking. The data just came in. And it tells a very different story than what most people expected. According to customs data, China shipped approximately 5,100 tons of silver overseas last year. Let me repeat that number because it is important. 5,100 tons. That is not a typo. That is not a decline. That is the highest volume of silver exports from China in at least 16 years. 16 years. The highest in 16 years. At the exact same time that the market was panicking about export restrictions, China was actually exporting more silver than they have in over a decade and a half. The shelves were not being locked down. The gates were not being closed. The silver was flowing out of China at a record pace. Now I know what some of you are thinking. You are thinking that I have lost my mind. You are thinking that I have gone bearish on silver. You are thinking that I'm about to tell you to sell everything and run for the hills. No. That is not what this video is about. This video is about understanding reality so that you can make better decisions. And the reality is more nuanced, more interesting, and frankly more bullish than the simple narrative that has been circulating. Let me take you back to October, because that is when this whole story started. The Chinese Ministry of Commerce issued a document extending the country's existing silver export licensing regime through 2027. It was a bureaucratic document, a procedural extension of existing policy. The kind of thing that governments do all the time when they want to continue current regulations. But something happened when that document hit the market. People misinterpreted it. They saw the word licensing and they thought restriction. They saw the extension through 2027 and they thought new controls. They took a routine policy continuation and turned it into evidence of an imminent crackdown. And here's where it gets really interesting. That misinterpretation did not stay contained. It spread. It spread through social media. It spread through financial news outlets. It spread through fund managers and bullion dealers and brokerages. It spread so far and so fast that it became the dominant narrative in the silver market. The impact was especially pronounced in India. Fund managers there publicly interpreted the policy extension as evidence of looming shortages. Major media outlets ran with the story. Brokerages told their clients that China was about to lock down silver exports. The narrative was amplified through online commentary until it became accepted wisdom. And then, something remarkable happened. The misinterpretation created real market effects. Indians loaded up ahead of Diwali. That seasonal buying, combined with tariff fears that kept supplies locked up in the United States, drained liquidity in London. Benchmark silver prices spiked to levels not seen since the 1970s. The speculation even caught the attention of Elon Musk, who commented on it, further amplifying investor attention. Do you see what happened here? A misread document created panic buying. The panic buying created actual supply tightness. The supply tightness pushed prices higher. The higher prices seemed to confirm the original narrative about restrictions. It became a self-fulfilling prophecy. The fear of a shortage created the shortage. This is one of the most fascinating market dynamics I have ever witnessed. The narrative was wrong. China was not restricting exports. They were exporting at record levels. But because enough people believed the narrative, they acted on it. And their actions created the very outcome they feared. Now, let me be clear about what the actual policy says, because the details matter. China has managed silver exports under a licensing system since 2019, when they replaced an older quota-based framework. Under the current regime, export licenses carry no explicit volume caps. Let me say that again, no explicit volume caps. The licenses are valid for 2 years, provided refiners meet minimum production thresholds of at least 80 tons of silver per year, or 40 tons for companies based in Western regions. Major exporters in China have confirmed that there has not been a significant change in shipments since the October document was issued. They say that most silver exports occur under existing processing trade arrangements that benefit from tax exemptions. One analyst from Jinrui Futures explained that any serious attempt to restrict exports would require revoking the tax relief on a large scale. That would be a far more significant policy shift than what was announced. The export rules have remained largely unchanged since the licensing system was introduced 7 years ago. Since then, silver exports from China have risen in all but 1 year. This increase largely reflects the expansion of non-ferrous refining capacity in China, where silver is produced as a byproduct of other metals processing. So the facts are clear. China is not restricting silver exports. They are licensing them under a system that has been in place for years. That system has no volume caps. Exports have been rising, not falling. And the record export volume of 5,100 tons proves that silver is leaving China at an unprecedented pace. But here is where I need you to think carefully, because this is not a bearish story. This is actually an incredibly bullish story if you understand what it really means. Think about what the data is telling us. China exported record amounts of silver last year. At the same time, silver prices hit record highs. How is that possible? If supply is flooding the market at record levels, how can prices be at all-time highs? The answer is simple. Demand is overwhelming supply. Even with record exports, even with 5,100 tons of silver leaving China and entering the global market, it is not enough. The demand is so intense, so structural, so relentless, that record supply cannot satisfy it. This is actually more bullish than the export restriction narrative. If China was restricting exports and that was causing prices to rise, the solution would be simple. China lifts the restrictions. Supply normalizes, prices fall. But if China is exporting at record levels and prices are still rising, what does that tell you? It tells you that the demand is real. It tells you that the shortage is structural. It tells you that even maximum supply from the world's largest silver processor cannot meet the world's appetite for this metal. Let me put some numbers on this. Industrial demand for silver reached approximately 680 million ounces in recent years. That accounts for around 60% of total global silver demand. Solar panels alone are consuming over 120 million ounces annually. Electric vehicles are adding another 70 to 75 million ounces. Grid upgrades and data centers are contributing more. At the same time, over 70% of silver is produced as a byproduct of other mining operations. This means supply cannot respond quickly to higher prices. You cannot just open a silver mine. You have to wait for lead and zinc and copper economics to justify increased production. This is the structural imbalance that is driving prices higher. It is not about China restricting exports. It is about the entire world needing more silver than the mining industry can produce. China's record exports prove that supply chains are functioning. But the price action proves that even fully functioning supply chains cannot satisfy demand. Now let me talk about what happened in India, because it illustrates another important dynamic. Indian investors are now buying more silver than they were in October. Think about that. The original buying spree that drained London liquidity was based on a misinterpretation of Chinese policy. But even after the facts became clearer, even after the data showed record Chinese exports, Indian demand has actually increased. According to the CEO of MMTC Pamp India, the country's largest precious metals refiner, investor demand for silver is now higher than it was during the October frenzy. Smaller bars and coins are particularly popular. This is the classic pattern of fear-driven accumulation. And the fear is not going away even as the original narrative is debunked. Why? Because the underlying anxieties are real, even if the specific trigger was misunderstood. Indian investors are not buying silver because they read a Ministry of Commerce document. They are buying silver because they distrust the rupee. They are buying silver because they see inflation eroding their savings. They are buying silver because they remember what happened to their parents and grandparents when currencies failed. The China export story was just a catalyst. The fundamental motivations run much deeper. This is what the skeptics miss when they say the rally is based on misinformation. Yes, the specific narrative about Chinese export restrictions was wrong, but the behavior it triggered reflects genuine concerns about monetary policy, currency debasement, and economic uncertainty. Those concerns do not disappear when you correct the misinformation. If anything, the fact that prices kept rising despite the debunking reinforces the underlying thesis that silver is a valuable hedge against systemic risks. Let me also address the longer-term picture, because intellectual honesty requires acknowledging the risks that remain. China has a track record of imposing export controls on strategically sensitive materials. They have done it with rare earths. They have done it with antimony. They have used resource control as a geopolitical tool. An analyst from Jinri Futures stated it clearly. There is no indication that there is tightening on export controls on silver at this stage. But given China's broader approach to resource management, the risk cannot be ruled out entirely over the longer term. This is the nuanced view that responsible analysis requires. Right now, today, China is not restricting silver exports. The licensing regime is functioning as designed. Silver is flowing out at record levels. But tomorrow, next year, if geopolitical tensions escalate, if trade wars intensify, if China decides that silver is strategically important for their domestic industries, the possibility of future restrictions is real. It is not the current reality, but it is a plausible future scenario. And smart investors position for plausible scenarios even before they materialize. The fact that China could restrict exports at any time, even if they are not doing so now, creates a risk premium that supports prices. So how should you think about all of this? Let me give you my framework for processing this information. First, understand that narratives matter even when they are wrong. The market does not trade on reality, it trades on perception. When enough people believe something, they act on it, and their actions create real market effects. The China export restriction narrative was factually incorrect, but it drove billions of dollars of buying that created genuine supply tightness. Perception became reality. Second, be skeptical of any narrative that is too clean, too simple, too perfect. Markets are messy. Reality is nuanced. When someone tells you a story that has no complications, no counter-arguments, no data that contradicts it, you should be suspicious. The best analysis acknowledges the complexity. The best analysis shows you both sides and helps you understand why the conclusion still holds despite the contradictions. Third, focus on structural factors, not catalysts. The China export narrative was a catalyst. It triggered buying at a specific moment, but catalysts come and go. What matters are the structural factors. Is industrial demand growing? Yes. Is supply constrained by byproduct economics? Yes. Are inventories depleted? Yes. Is the gold-silver ratio still elevated by historical standards? Yes. These structural factors persist regardless of what any Ministry of Commerce document says. Fourth, understand that this kind of market behavior, where misinterpretation creates real effects, is going to happen again. Social media accelerates the spread of information, both true and false. Financial media amplifies narratives without always verifying them. Retail investors act on what they read online. This creates feedback loops where narrative and reality become intertwined in ways that are hard to separate. Now let me address the supply and demand picture more directly, because this is where the analysis gets really interesting. If we look at the current balance, demand appears exceptionally strong. The data confirms this. Industrial consumption is running near record levels. Investment demand is adding incremental pressure. Solar installations are expanding. Electric vehicles are multiplying. The technological applications for silver are growing faster than the mining industry can respond. At the same time, there are macroeconomic factors supporting silver that have nothing to do with China. Rising reliance on assets not denominated in the US dollar is one factor. The protectionist policies associated with the current US administration have created uncertainty about dollar-denominated assets. Investors globally are looking for alternatives. Gold and silver benefit from this rotation. The interplay between real and nominal yields is another factor. When real yields are negative or near zero, the opportunity cost of holding precious metals declines. Gold and silver do not pay dividends or interest, but that matters less when bonds and savings accounts are not paying either. These factors would support silver prices regardless of what China does with export policy. They are independent variables that happen to be pointing in the same direction. This is what creates powerful bull markets. When multiple independent factors align, when structural supply constraints meet rising demand, when macroeconomic conditions favor hard assets, you get moves that exceed what any single factor would produce. So where does all of this leave us? It leaves us with a more sophisticated understanding of what is happening in the silver market. The simple narrative about China restricting exports is wrong. The data proves it. 5,100 tons of exports, the highest in 16 years, is not a restriction. It is a flood. But the conclusion that silver is going higher may still be correct. The structural demand is real. The supply constraints are real. The macroeconomic tailwinds are real. The psychological factors driving retail accumulation are real. And ironically, the very misinformation that fueled the rally has created real buying that has tightened real supply. This is the kind of nuanced analysis that you will not get from channels that just tell you what you want to hear. I could have made a video saying, China is locking down silver, buy, buy, buy. It would have gotten more clicks. It would have been simpler, but it would have been wrong. And I respect you too much to lie to you. The truth is more interesting than the fiction. The truth is that perception and reality are interacting in complex ways. The truth is that wrong narratives can create right outcomes through unexpected mechanisms. The truth is that silver is in a structural bull market that does not depend on any single story being true. Let me give you some perspective on where prices might go from here. Analysts are looking at targets in the $100 to $120 range. The gold-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, is expected to compress toward 50 to 1 by year-end. If gold stays at current levels around $4,800, That would imply a silver price of $96 at 50 to 1. If gold continues higher, as many expect, the implied silver price rises accordingly. But I want to be careful about predictions because the market has a way of humiliating anyone who claims to know the future. What I can tell you is that the setup remains bullish. The demand is strong. The supply is constrained. The macro backdrop is supportive. And despite the record exports from China, prices are holding near all-time highs. That resilience tells you something. It tells you that the buying interest is deeper than a single misinterpreted document. It tells you that the accumulation is structural, not speculative. It tells you that even when the bears get ammunition, even when the narrative is debunked, the market absorbs the selling and keeps moving higher. I want to close with a thought about intellectual honesty and why it matters for your success as an investor. It would be easy for me to ignore this export data. It would be easy for me to keep pushing the China restriction narrative because it is bullish and my audience wants to hear bullish things. But that approach, telling people what they want to hear instead of what they need to know, is a disservice. It might build a bigger audience in the short term, but it destroys credibility in the long term. My job is not to make you feel good. My job is to help you understand what is actually happening so that you can make better decisions. Sometimes that means telling you things that complicate the narrative. Sometimes that means showing you data that contradicts popular beliefs. Sometimes that means saying I was wrong about something I previously thought was true. The China export restriction story was wrong. I am saying that clearly and directly. But the silver bull market is not wrong. The structural factors remain in place. The demand continues to grow. The supply continues to be constrained. And even record exports from the world's largest processor are not enough to satisfy the world's appetite for this metal. That is the real story. That is the story that matters for your portfolio. And that is the story that I will keep tracking and reporting as it unfolds. This is Mr. AAG Asian Guy, bringing you silver analysis that separates fact from fiction. If this video gave you a new perspective, if it challenged something you believed and helped you understand the market better, smash that subscribe button. Hit the notification bell. Drop a comment below telling me what you think about the China export data. Did you believe the restriction narrative? What do you think now? I read every comment, and I want to know how this information is landing with you. The silver story is still being written. The next chapter might surprise us all. But if we stay focused on data, if we stay focused on structural factors, if we stay honest about what we know and what we do not know, we will be positioned to benefit regardless of what headlines come next. Stay sharp, stay skeptical. And remember, AG is the way. See you in the next one.